$700 a month. That's the average new car payment in America today, according to Edmunds data from late 2023. For context, that's more than many Americans pay in rent in affordable markets, more than a typical grocery bill for a family of four, and nearly double what the average car payment was just 15 years ago. This isn't an outlier for luxury buyers. This is the statistical average across all new car purchases. The question isn't whether this happened, the data is clear. The question is how we got here, and what economic forces transformed this $700 monthly obligation into something ordinary. To answer that question, we need to follow the complete economics of a car purchase from beginning to end. That means tracking not just the sticker price, but the down payment, the interest charged over the life of the loan, the insurance premiums, and the depreciation that begins the moment you drive off the lot. Each of these components has shifted over the past 2 decades. Some have grown modestly. Others have exploded. Together, they form a system that has fundamentally changed what it means to buy a car in America. Let's begin with the most visible number, the manufacturer's suggested retail price. According to Kelley Blue Book, the average transaction price for a new vehicle in the United States reached $48,247 in late 2023. That's not for luxury vehicles or loaded trucks, that's the average across all segments, from compact sedans to full-size SUVs. Cox Automotive reports the figure even higher at certain points, exceeding $50,000 during peak demand periods. 20 years ago, the average new car cost around $28,000 in nominal dollars. Adjusted for general inflation, that 2003 price would equal roughly $45,000 today. So even accounting for inflation, new cars have gotten measurably more expensive. Multiple factors drove prices upward. Automakers shifted production toward higher-margin vehicles. SUVs and trucks now account for roughly 80% of new vehicle sales, according to industry analysts, compared to about 50% 2 decades ago. Regulatory requirements added cost. Backup cameras became mandatory in 2018, electronic stability control in 2012, and increasing fuel economy standards pushed manufacturers toward expensive lightweighting and hybrid systems. Then came supply chain disruptions during the pandemic, semiconductor shortages, and a shift in dealer behavior from high-volume low-margin sales to low-volume high-margin transactions. Each factor added hundreds or thousands to the sticker price. Traditional lending advice suggested a 20% down payment on a car purchase. On a $48,000 vehicle, that would mean $9,600 in cash up front. But Edmunds data shows the average down payment in recent years hovers around 11 to 12%, roughly $5,300 on that average vehicle. Some buyers put down significantly less. Cox Automotive reports that a growing segment of buyers, particularly those trading in vehicles with negative equity, effectively put zero down or even rolled debt from their previous car into the new loan. Lower down payments mean higher principal balances, which means more interest paid over time. With a 12% down payment on a $48,247 vehicle, the buyer finances approximately $42,450. But that's before taxes, title, registration, and dealer fees. Sales tax alone, at a 7% rate common in many states, adds roughly $3,377. Registration and documentation fees vary widely but typically add another $500 to $800 according to DMV data across multiple states. Many buyers finance these costs rather than paying them up front. So the actual loan amount often reaches $46,000 to $47,000, even on a car with an average sticker price. That's the number on which interest begins to accumulate. Interest rates on auto loans vary by credit score, loan term, and market conditions. According to Edmunds, the average annual percentage rate on a new car loan in late 2023 ranged from 6.5% to 7.5% for buyers with good credit, and significantly higher for subprime borrowers. This represents a dramatic increase from 2020 and 2021, when average rates sat below 4%. The Federal Reserve's rate hikes to combat inflation directly impacted auto lending. A borrower with a 700 credit score might have secured 3.5% in 2021, by late 2023, that same borrower faced rates near 7%. This shift alone added thousands to the total cost of a vehicle. Here's where the math gets critical. According to Experian's State of the Automotive Finance Market, the average loan term for a new car reached 68 months in recent data, more than 5.5 years. But that average conceals a significant shift in the distribution. Experian reports that loans of 72 months or longer now account for roughly 40% of all new car financing. Loans of 84 months, 7 full years, represent a growing share, particularly for trucks and SUVs with prices above $50,000. A decade ago, 60-month loans were standard and 72 months was considered extended. Today, 84 months is increasingly common. Let's run the numbers on a 72-month loan. Take that $46,500 financed amount at 7% APR over 6 years. The monthly payment comes to approximately $700. Total payments over the life of the loan, $50,400. That means the buyer pays $3,900 in interest charges, about 8.4% of the original loan amount. Now consider what happens if that same buyer had chosen a 60-month term instead. The monthly payment would rise to roughly $800, but total interest paid would drop to around $3,200, saving $700. The 72-month loan reduced the monthly burden by $100 but cost an extra $700 in interest. That trade-off is central to understanding normalized high payments. Extend the term to 84 months and the equation shifts further. That same $46,500 at 7% over 7 years yields a monthly payment of approximately $640. The payment dropped by $60 compared to the 72-month loan, making it appear more affordable. But total interest paid climbs to roughly $4,560, $660 more than the 72-month option and $1,360 more than a 60-month loan. The buyer pays nearly 10% of the loan amount in pure interest. Meanwhile, for most of the loan's life, the vehicle's value will be falling faster than the principal balance declines, creating negative equity. This is the mechanism by which expensive vehicles become financially accessible. Time stretches the cost, lowering monthly payments while raising total expenditure. Consumer behavior research shows that buyers increasingly focus on monthly payment rather than total vehicle price or loan cost. A study by the Consumer Financial Protection Bureau found that many buyers enter the dealership with a target monthly payment in mind, say, $600 or $700, rather than a target purchase price. Dealers accommodate this by adjusting loan terms rather than price. If the payment is too high at 60 months, they extend to 72. Still too high? Move to 84. The vehicle price rarely changes, only the time horizon stretches. This shift in consumer psychology, from price-conscious to payment-conscious, enabled the rise of expensive vehicles financed over extended terms. Monthly car payments don't end with the loan. Insurance is mandatory in nearly every state, and according to Bankrate data from 2023, the average annual cost of full coverage auto insurance in the United States reached approximately $2,150. That's roughly $179 per month on top of the loan payment. Rates vary dramatically by state. Michigan and Louisiana drivers often pay more than $3,000 annually, while drivers in Maine or Vermont may pay half that. But the national average has climbed steadily. Insurance Information Institute data shows auto insurance premiums rose faster than general inflation between 2020 and 2023, driven by higher vehicle repair costs, increased accident severity, and supply chain issues affecting parts availability. Several factors pushed insurance premiums higher. Modern vehicles contain expensive technology, advanced driver assistance systems, sensors, cameras, and complex infotainment units that cost thousands to repair or replace after even minor collisions. The Insurance Institute for Highway Safety notes that a fender bender that once cost $1,500 to fix can now run $4,000 or more if sensors are damaged. Used car price inflation during 2021 and 2022 also increased total loss payouts, forcing insurers to raise premiums. Additionally, distracted driving and an uptick in accident severity contributed to higher claims. For the average buyer, this means the true monthly cost of a vehicle includes not just the $700 loan payment, but another $180 or more for insurance. Depreciation is the least visible but often the largest cost of vehicle ownership. According to Kelley Blue Book and industry standard estimates, a new car typically loses 20% to 30% of its value in the first year, and roughly 50% to 60% over 5 years. On a $48,000 vehicle, that means approximately $10,000 in value lost in year 1, and $24,000 to $29,000 over 5 years. This isn't a cash outflow the way a monthly payment is, but it's a real economic cost. The buyer who finances $46,500 over 72 months will owe roughly $30,000 after 3 years, while the vehicle may be worth only $28,000. That's negative equity, owing more than the car is worth. Negative equity creates a compounding problem. Edmunds data from recent years shows that roughly 1/3 of trade-ins carry negative equity. The buyer owes more than the trade-in value. The average amount of negative equity among those underwater trades is approximately $5,000 to $6,000 according to industry reports. When that buyer purchases their next vehicle, they often roll that debt into the new loan, starting the cycle again with an even higher principal balance. This buyer might finance $50,000 or more on a $48,000 car, immediately deepening their negative equity position. Extended loan terms exacerbate this, because the principal balance declines slowly while depreciation accelerates early in the vehicle's life. Now let's add it all up. Purchase a vehicle for $48,247 with a 12% down payment. Finance $46,500 at 7% for 72 months, total payments of $50,400. Add insurance at $179 per month for 6 years, $12,900. Include maintenance, fuel, and registration. AAA estimates these run roughly $3,000 to $4,000 annually for an average sedan, or $18,000 to $24,000 over 6 years. After 6 years of ownership, the buyer has spent approximately $80,000 to $87,000 in total. At that point, the vehicle, originally $48,247, is worth perhaps $15,000 to $18,000 according to standard depreciation curves. The true cost of that car was not $48,000. It was more than $65,000 in out-of-pocket expenses, plus $30,000 in depreciation. Extended loan terms create an affordability illusion. A $60,000 truck might seem out of reach at $1,100 per month on a 60-month loan. But stretch it to 84 months and the payment drops to roughly $825, which feels manageable, only $125 more than the average payment. The buyer perceives they can afford a more expensive vehicle than they actually can, because the monthly burden has been distributed across 7 years instead of 5. Lenders accommodate this because longer loans mean more interest revenue. Dealers accommodate it because higher vehicle prices mean higher commissions. The system is structured to make expensive vehicles appear affordable by manipulating the time variable. Let's compare the same $50,000 vehicle across different loan structures to see the impact clearly. At 60 months and 7% APR, monthly payment is roughly $990. Total interest is $4,400, and the buyer owns the car in 5 years. At 72 months, payment drops to $850, but total interest climbs to $5,200. At 84 months, payment falls to $745, while total interest reaches $6,000. The buyer saves $245 per month by choosing 84 months over 60, but pays an extra $1,600 in interest and spends nearly 2 additional years in debt. The vehicle will likely need major repairs, brakes, tires, suspension work before the loan is paid off, adding yet more cost. Experian's automotive finance data reveals that subprime and deep subprime borrowers, those with credit scores below 620, account for roughly 20% of new and used car loans. These buyers face significantly higher interest rates, often 10% to 15% or more, and are disproportionately likely to choose extended loan terms to manage monthly payments. A subprime borrower financing $40,000 at 12% APR over 84 months would pay nearly $700 per month and more than $18,000 in interest over the loan's life. These buyers are also more likely to experience default. Experian data shows subprime auto loan delinquency rates running 5% to 6%, significantly higher than prime borrowers. Extended terms and high rates create a debt trap for vulnerable buyers. Lenders profit from longer loan terms and higher interest rates, creating an incentive to push buyers toward extended financing. A 2019 analysis by the Consumer Financial Protection Bureau found that dealer markups on interest rates, where the dealer adds percentage points above the lender's buy rate and keeps the difference as profit, were common and could add thousands to the cost of a loan. While some reforms have limited egregious markups, the practice continues. Captive finance arms of automakers, Ford Credit, GM Financial, Toyota Financial, also profit from longer terms. A 72-month loan generates 20% more interest revenue than a 60-month loan at the same rate. These structural incentives align dealer, lender, and automaker interests around extended financing, regardless of borrower outcomes. Industry data from Edmunds and IHS Markit shows that the average vehicle ownership period in the United States is approximately 6 to 7 years for new cars. But many buyers trade in sooner, after 3 to 5 years, seeking newer technology, lower repair costs, or simply a different vehicle. When a buyer with a 72 or 84-month loan trades in after 4 years, they're almost always underwater. They've paid down perhaps 55% of the principal, but the vehicle has depreciated 60% or more. The negative equity rolls into the next loan, and the cycle repeats. This creates a perpetual payment structure where the buyer never builds equity and never escapes the monthly obligation. It's financially similar to leasing, but without the warranty protection or lower payments leasing typically offers. Extended loan terms mean buyers are still making payments long after the factory warranty expires. Most new car warranties cover 3 years or 36,000 miles for bumper-to-bumper coverage, and 5 years or 60,000 miles for powertrain. According to AAA, average annual maintenance and repair costs for a vehicle increase significantly after year 5, often reaching $1,200 to $1,500 per year or more for older vehicles. A buyer with an 84-month loan will be making payments in years 6 and 7 while simultaneously facing higher repair bills. This dual-burdened loan payment plus major repairs can push total monthly vehicle costs well above $1,000, straining budgets and sometimes triggering default or forced trade-in into negative equity. Beyond loan payments, insurance, and repairs, fuel represents a significant ongoing cost. The U.S. Energy Information Administration reports that gasoline prices averaged around $3.50 per gallon in 2023, down from peaks above $5 but still elevated compared to pre-pandemic levels. The average American drives roughly 13,500 miles per year according to the Federal Highway Administration. A vehicle getting 25 miles per gallon would consume 540 gallons annually, costing approximately $1,900 in fuel. For trucks and SUVs averaging closer to 20 miles per gallon, that figure rises to $2,400 or more. Add in oil changes, tire rotations, and other routine maintenance, AAA estimates another $800 to $1,200 annually, and operating costs alone run $3,000 to $3,500 per year, or roughly $250 to $300 per month. Add all monthly costs together for the average new car buyer. Start with the $700 loan payment. Add $179 for insurance. Include roughly $160 for fuel at $1,900 annually. Add $100 per month for maintenance and repairs, averaged over the year. The total monthly cost of vehicle ownership reaches approximately $1,140, and that's using conservative estimates and assuming no major breakdowns. For buyers in expensive insurance states, or those with subprime loans carrying higher interest, or those driving less efficient vehicles, the figure easily exceeds $1,300 per month. According to Census Bureau data, median household income in the U.S. is roughly $75,000, or about $6,250 per month pre-tax. That $1,140 vehicle cost represents 18% of gross income, well above the 15% to 20% financial advisors typically recommend for all transportation expenses combined. These rising vehicle costs occur against a backdrop of relatively stagnant real wages for many Americans. According to the Pew Research Center, inflation-adjusted wages for middle-income workers have grown only modestly over the past 2 decades, with median household income increasing roughly 20% in real terms since 2000. Vehicle prices, by contrast, have increased 70% or more in nominal terms. The gap between income growth and vehicle cost growth means cars consume a larger share of household budgets than they did a generation ago. This squeeze forces buyers to choose between extended loan terms, used vehicles, or foregoing car ownership, a difficult choice in a country where public transportation is limited in most regions and car ownership is often essential for employment. Rising new car costs have pushed many buyers toward the used market. According to Edmunds, the average used car price reached approximately $26,000 to $28,000 in late 2023, down from pandemic peaks above $30,000 but still elevated compared to pre-2020 levels. Used car prices spiked during the pandemic due to new car shortages, semiconductor supply issues, and rental car companies buying inventory to rebuild fleets. Even as prices have moderated, used vehicles remain expensive relative to historical norms. However, financing a $27,000 used car over 60 months at 8% APR rates are typically higher on used vehicles yields a monthly payment around $550, significantly less than the $700 average for new. For budget-conscious buyers, used remains the more accessible option, though it comes with higher maintenance risk and no warranty. Leasing offers another path, typically with lower monthly payments than purchasing. Industry data shows that roughly 20% to 25% of new vehicles are leased rather than purchased. A lease on a $50,000 vehicle might run $450 to $500 per month with minimal down payment, compared to $850 or more to finance the same vehicle. However, leases come with mileage restrictions, typically 10,000 to 12,000 miles per year, and excess mileage fees of 15 to 25 cents per mile. At lease end, the lessee has no equity and must either lease another vehicle, purchase the car at the residual value, or walk away. For buyers who want lower payments and drive limited miles, leasing can make sense. For those who drive extensively or want to own, it's a poor value. Electric vehicles add another dimension to the affordability question. According to Kelley Blue Book, the average EV transaction price in 2023 was approximately $52,000 to $55,000, though federal tax credits of up to $7,500 can reduce effective cost for qualifying buyers. EVs promise lower operating costs, electricity is cheaper than gasoline per mile, and maintenance is reduced due to fewer moving parts. However, higher upfront costs mean higher loan payments. A $52,000 EV financed over 72 months at 6.5% yields roughly $775 per month. Insurance is often higher due to expensive battery packs and repair complexity. While total cost of ownership may favor EVs over time, a higher monthly payment presents an immediate affordability barrier for many buyers. The COVID-19 pandemic and its aftermath dramatically reshaped the auto market. Semiconductor shortages shut down production lines throughout 2021 and 2022, reducing new vehicle inventory to historic lows. According to Cox Automotive, dealer inventories fell from roughly 3.5 million vehicles in early 2020 to under 1 million by mid-2021. Scarcity drove prices up, many dealers charged over MSRP, adding $5,000 or $10,000 in market adjustments. Used car prices spiked as buyers unable to find new cars bid up the used market. Supply chain issues persisted into 2023, keeping inventories constrained and prices elevated. While markets have begun to normalize, prices have not fully retreated to pre-pandemic levels, and buyer expectations have adjusted upward. Beyond economics, a cultural shift has contributed to normalized high payments. Automotive analysts note that vehicles have increasingly become status symbols and personal statements rather than mere transportation. The rise of luxury trucks, Ford F-150s and Chevrolet Silverados with $70,000 price tags, equipped with leather, advanced tech, and premium audio, reflects buyers' willingness to stretch budgets for perceived lifestyle value. Social media amplifies this, with influencers and advertisers showcasing expensive vehicles as aspirational. Market research shows that buyers often prioritize features like large touchscreens, premium sound systems, and brand prestige over affordability. This cultural dimension makes the $700 payment not just economically normalized but socially expected in certain demographics. Government regulations have added both cost and value to vehicles. The National Highway Traffic Safety Administration mandates numerous safety features: electronic stability control, tire pressure monitoring, backup cameras, and increasingly, automatic emergency braking. These technologies save lives. NHTSA data shows significant reductions in certain crash types after mandate implementation. But they also add cost. Industry estimates suggest that mandatory safety and emissions equipment adds $2,000 to $4,000 to vehicle prices compared to early 2000s models. Fuel economy standards push automakers toward expensive lightweighting, turbocharging, and hybridization. Buyers receive safer, more efficient vehicles, but at a price premium that feeds into higher monthly payments. The dealer business model has evolved to prioritize finance and insurance profit over vehicle sales. According to the National Automobile Dealers Association, dealerships earn roughly half their gross profit from finance, insurance, and service departments, despite these representing a fraction of transactions. Extended warranties, gap insurance, paint protection, and interest rate markups generate significant revenue. A dealer may sell a vehicle at invoice or slight loss, then recapture profit through financing, earning a percentage of the interest paid over the loan's life and commissions on add-on products. This model incentivizes dealers to maximize loan amounts and extend terms, as longer loans mean more interest and more opportunity to sell additional products. Credit scores determine access and cost. Experience data shows that borrowers with excellent credit scores above 740 might secure rates as low as 5% to 6%, while those with scores below 600 face rates of 12% to 18% or higher. On a $40,000 loan over 72 months, the difference between 6% and 14% is approximately $200 per month, $650 versus $850. Over the loan's life, a higher rate costs an additional $14,000. This disparity means that lower-income buyers, who statistically have lower credit scores, pay far more for the same vehicle than affluent buyers. The system is regressive. Those least able to afford high payments are charged the most. Subprime lenders specialize in this market, offering approval to nearly anyone but at punishing rates. Auto loan debt in the United States has reached record levels. According to the Federal Reserve Bank of New York, total outstanding auto loan debt exceeded $1.5 trillion in 2023. This represents a steady climb from roughly $800 billion in 2010. The average auto loan balance has also grown, from around $22,000 in 2010 to more than $32,000 in recent years, per Experian data. This accumulation reflects both higher vehicle prices and longer loan terms that keep buyers in debt longer. Delinquency rates, the percentage of loans 90-plus days past due, have ticked upward from historic lows during the pandemic, reaching 5% to 6% for subprime borrowers. The scale of auto debt rivals student loan debt and exceeds credit card debt in many demographics. Lenders require borrowers to carry comprehensive and collision insurance until the loan is paid off, ensuring the lender's asset is protected. This requirement adds cost, particularly for drivers in high-rate states or those with poor driving records. For a young driver with a minor accident history financing a $40,000 vehicle, insurance can easily exceed $250 per month, more than a third of the loan payment. Some buyers, facing unaffordable insurance quotes, opt for state minimum liability coverage and risk loan default if caught. Lenders may force place insurance expensive coverage purchased on the borrower's behalf if proof of insurance lapses, adding even more cost. The insurance requirement compounds affordability challenges and can push total monthly obligations well above $1,000. Vehicle costs vary dramatically by geography. According to the Bureau of Labor Statistics, urban residents in the Northeast and West pay significantly more for insurance, registration, and even vehicle prices due to market demand and dealer pricing power. Rural buyers often face limited dealer competition, reducing negotiating leverage. Sales tax rates range from 0% in states like Oregon and Montana to more than 9% in parts of California and Tennessee. On a $50,000 vehicle, the tax difference is $4,500, nearly 10% of the price. Fuel costs also vary regionally. California drivers pay $1 or more per gallon above the national average. These geographic disparities mean a $700 payment in one state might represent a very different total cost of ownership than in another. The new versus used decision represents a fundamental trade-off. New cars offer warranties, the latest technology, and known history, but cost significantly more and depreciate rapidly. Used cars cost less upfront and have already absorbed the steepest depreciation, but carry higher maintenance risk, unknown history, and typically higher interest rates. A 3-year-old certified pre-owned vehicle might cost $30,000 instead of $50,000 new, cutting monthly payments from $850 to $550. However, it may have 30,000 to 40,000 miles, a shorter remaining warranty, and require tires or brakes soon. For buyers prioritizing affordability, used is nearly always the better choice. For those prioritizing reliability and features, new wins despite the cost. Consumer financial literacy around auto loans remains low. Studies by the National Foundation for Credit Counseling show that many buyers don't understand APR, total interest paid, or the impact of loan term on total cost. Dealers exploit this gap, focusing negotiations on monthly payment rather than price or interest rate. A buyer who asks, "Can you get me to $600 a month?" gives the dealer control over every other variable. The dealer can raise the price, extend the term, or mark up the interest rate, as long as the payment hits $600. Financial education initiatives emphasize the importance of negotiating price first, securing financing independently, and calculating total cost rather than fixating on payment. But these lessons reach only a fraction of buyers. The shift from sedans to SUVs and trucks has fundamentally changed average vehicle prices. In 2000, sedans and coupes accounted for roughly 50% of sales. By 2023, that figure fell below 20%, according to automotive industry analysts. SUVs and trucks dominate, driven by buyer preference for space, capability, and perceived safety. But these vehicles cost significantly more. A midsize sedan might start at $28,000, while a comparable midsize SUV starts at $35,000 or higher. Trucks like the Ford F-150 and Chevrolet Silverado, America's best-selling vehicles, frequently transact above $50,000 with popular option packages. This categorical shift alone explains several $1,000s of the average price increase, independent of inflation or added features. Automakers use incentives, rebates, low APR financing, and loyalty bonuses to move inventory and manage demand. During periods of excess inventory, manufacturers may offer 0% APR for 60 months or $5,000 cash rebates. These deals can significantly reduce total cost. 0% financing eliminates interest charges entirely, saving thousands compared to market rates. However, incentives are selective, applied to slow-selling models or discontinued vehicles, not hot sellers. According to Edmunds, average incentive spending by manufacturers was approximately $2,500 to $3,000 per vehicle in 2023, down from pandemic lows but still substantial. Savvy buyers can leverage incentives to reduce cost, but many buyers either don't know about them or purchase vehicles where few incentives are available. Environmental concerns and social pressure increasingly influence vehicle purchases. Buyers face messaging around fuel efficiency, emissions, and climate impact. This drives demand for hybrids and EVs, which typically cost more upfront. A Toyota RAV4 hybrid costs roughly $3,000 to $4,000 more than the gas-only version, while a full EV commands an even steeper premium. Buyers willing to pay for environmental benefits accept higher payments. Social pressure, neighbors buying Teslas, workplace charging infrastructure, tax credits for green vehicles reinforces this trend. While motivations are laudable, the economic result is higher average transaction prices and, consequently, higher monthly payments. Environmental goals and affordability are in tension, particularly for middle-income buyers. Automakers are experimenting with subscription services for features, heated seats, advanced cruise control, performance boosts that require ongoing monthly fees. BMW faced backlash for charging $18 per month for heated seats in markets outside the US. Other manufacturers bundle subscriptions into connected services. These fees add to ownership costs. A buyer paying $15 per month for navigation, $10 for premium connectivity, and $20 for advanced driver assistance features adds $540 annually, $45 per month on top of the loan, insurance, and fuel. While these subscriptions are often optional, buyer expectations around technology features make them feel necessary. This trend represents a shift from one-time purchase to perpetual payment, further normalizing continuous vehicle-related expenses. Insurers increasingly offer telematics programs, devices or apps that monitor driving behavior and adjust premiums accordingly. Safe drivers can save 10% to 30% on insurance, according to industry data, while risky drivers may see rates increase. Programs like Progressive Snapshot or State Farm's Drive Safe and Safe track acceleration, braking, speed, and mileage. While these programs can reduce costs for disciplined drivers, they raise privacy concerns and can penalize those who drive at night, in traffic, or in urban environments where hard braking is common. The trend toward usage-based insurance adds complexity to cost calculations and creates variability in monthly expenses that wasn't present in traditional fixed premium models. High car payments create economic vulnerability. For households living paycheck to paycheck, nearly 60% of Americans, according to some surveys, a $700 car payment leaves little margin for unexpected expenses. A medical bill, job loss, or major repair can trigger a cascade: missed payments, repossession, damaged credit, and difficulty securing future loans. Federal Reserve data shows auto loan delinquencies are an early indicator of broader financial stress. When households default on car loans, they often lose transportation needed for work, compounding financial hardship. The normalization of high payments has thus increased systemic economic fragility, particularly among middle and lower-income households heavily reliant on personal vehicles. Addressing affordability requires systemic and individual changes. Buyers can lower costs by purchasing used, negotiating price before discussing payment, securing independent financing, choosing shorter loan terms despite higher monthly payments, and avoiding add-on products like extended warranties of dubious value. Policymakers could cap loan terms, require clearer disclosure of total interest costs, or restrict dealer interest rate markups. Public transportation investment would reduce car dependency in urban areas. Car sharing and ride-hailing offer alternatives for some, though typically at higher per-mile costs. None of these solutions are panaceas, but collectively they could bend the cost curve downward and reduce reliance on debt-financed transportation. The $700 car payment didn't happen by accident. It emerged from a confluence of forces: rising vehicle prices driven by the shift to SUVs and trucks, regulatory costs, and supply chain disruptions, stagnant real wages that squeezed household budgets, the extension of loan terms to 72 and 84 months, which lowered monthly payments while raising total costs, aggressive dealer and lender incentives to maximize financing revenue, and a cultural shift that valorized expensive vehicles as status symbols. Each factor individually might have been manageable. Together, they created a system where expensive vehicles became financially accessible through debt, and where $700 monthly payments transitioned from luxury outlier to statistical norm. Understanding this system is the first step toward questioning whether it serves buyers' long-term interests or primarily the interests of those selling and financing the vehicles.